Good afternoon, financial professionals. My name is Jennifer Nadeau, Case Design Specialist here at E4 Insurance Services, welcoming you to The Brew, building relationships every week. Thanks for tuning in today. For those of you joining The Brew for the first time, we like to start the Brewcast by celebrating today's National Day. And on a serious note, today is National Day of the Deployed. So we certainly give thanks to our military and their sacrifices that they make for this country and to their families every day. It's also National Tennessee Day. It's National Pumpkin Day, very fitting as we close out the month of October. And it's also National Financial Crime Fighter Day. And while not having a financial plan is not a crime, it can be concerning, which brings us to our guest. On today's Brew, we welcome Jason Jafferis, Regional Vice President with Prudential, as he discusses the flexible wealth transfer strategy using SLATs, or Spousal Lifetime Access Trusts. Today, Jason will share why using a SLAT strategy provides flexibility for planning, access to cash value, and maintains death benefit outside of the estate. As usual, please feel free to use the chat box to share your thoughts or ask questions. And also, all attendees are in a drawing for a prize, and we will announce the winner at the end of our call today. Thank you for tuning in. And Jason, welcome again to The Brew. So happy to have you.
Thank you very much. Glad to be here and enjoy being on these calls, and look forward to as many opportunities as I can to help provide ideas and concepts to our advisors.
Well, thank you. And we absolutely appreciate that. So SLATs, you're here today to talk about Spousal Lifetime Access Trusts. Let's start out with the basics. What is a SLAT?
So a SLAT is a more recent conversation of planning. Really what it is, it's an insurance, irrevocable life insurance trust with special provisions built into it that allows access to the cash value and to money inside the trust through trustee and beneficiary arrangements that are set up with the trust language. So in essence, it is an ILIT that has flexibility to allow access to the assets inside the trust, including the life insurance.
Okay, makes sense. How does it, can you explain to us a bit about how it works?
Sure. With a married couple, if we want to look at a married couple that is looking to put life insurance or assets outside of the estate for estate tax purposes, obviously trying to avoid estate taxes upon death, they typically would set up an irrevocable life insurance trust that gets that asset outside of the trust. The issue with ILITs and with a wait and see approach for many clients is that once those assets are set inside the trust, there's no access to them, right? It's very difficult to get the assets back out, and plans can change. What the SLAT allows you to do is name one of the married couple as the grantor. So it could be the husband, could be the wife, doesn't matter. One of them is named the grantor of the trust. The other spouse would be listed as a beneficiary. And so what that allows you to do is fund the trust through the grantor. The beneficiaries have access to the trust during the life of the grantor, and thus have access to the assets, and in this case, with life insurance, cash value inside that policy.
Excellent. So when we utilize insurance with this strategy, are we only talking about second to die or survivorship type policies? What can be used with this strategy?
Yeah, oftentimes the majority of the SLATs that we see in today's marketplace are survivorship, simply because of the leverage that you get with pricing. And oftentimes you'll have one of the insureds as the grantor, the other insured as the beneficiary. And it's more of a leverage play to get as much insurance as you can for the least amount of cost. And that's where a second to die policy comes into play. There are a couple of downsides to that. If the grantor spouse passes away before the grantor spouse, you, in essence, almost turn off that access to cash. It's now available only to the remaining beneficiaries of the trust, which usually is the children, or in some instances, the grandchildren as well. The other thing to be, I guess, concerned with is the funding pattern, because if the grantor spouse dies prematurely before the non-grantor spouse, the gifts to the trust cannot come from the non-grantor spouse. They have to be assets in the name of the grantor spouse. So oftentimes the way that we see the design is a very short pay design, a 5-pay or a 10-pay, to ensure that the grantor spouse can get all the assets into the trust in a timely manner, and avoiding the potential for death shutting off the spigot to the funding of the trust. If this does become a concern, the SLAT can also be set up with just 2 individual policies. You can set up 2 individual SLATs, one insuring the husband, one insuring the wife in a married couple case, and then the non-insured spouse would be the beneficiary of that particular trust. So a husband would set up a SLAT, name themselves as the grantor. Then the spouse would be the beneficiary of that SLAT. Then the wife can set up another SLAT, own life insurance inside that SLAT, and have the husband set up as the beneficiary of that trust. And the downside there is obviously you're buying 2 policies. So from a cost-effective standpoint, it does become more expensive. However, that situation does provide even more flexibility, because you don't have any concerns about funding pattern, or any spouse kind of prematurely dying. Once that spouse dies, the money goes into the trust and is available for the beneficiary in full.
So the 1 or 2 trust idea, really, it's determined by comfortability and flexibility, right? And what our customers are comfortable with, whether they feel more comfortable with 2 or 1, if I'm understanding that correctly.
Correct. Yeah. And the reason I mentioned that most of the scenarios we see are survivorship is it really comes down to an estate tax issue.
Yes.
And they're looking for the maximum amount of leverage they can get to buy the most insurance. But they're just a little bit uncomfortable with giving up control of the asset. You know, especially in today's product world, where most of the products that we sell do have cash accumulation. There's very few true, like, guaranteed UL policies out there that don't have cash value buildup. So that cash value, they see that as losing control, and the SLAT concept gives them some availability of control while they're still alive, where if needs changed and they needed to maybe pull the ripcord and exit the strategy, there's a way to access that cash value through the Spousal Lifetime Access Trust.
Okay, so if I'm thinking about a SLAT and an ILIT, and I'm differentiating the 2, which you did a great job defining and explaining what a SLAT is it basically that a SLAT allows for more control? Is that a correct way to think of it?
It's a provision that you can put into your ILIT that does allow access to the cash. So it does provide them more control. It does provide that the beneficiary that's listed within the trust has access to the assets and the cash value that is inside of that. Typically, we don't look at a husband and wife who maybe put a survivorship policy into a trust, giving one of them access. The Spousal Lifetime Access Trust language that's built into the ILIT specifically is designed to allow that. Oftentimes, with a survivorship too, you have to be a little bit careful about how you access the money. Usually it is still restricted more for HEMS, if you're familiar with that term: health, education, maintenance, and support. Most trustees would feel that if you're accessing the cash for any particular need, it can qualify for one of those definitions. But again, that's something to work with the tax attorney or the tax planner on the specific design of the trust, just to ensure that they understand exactly what is accessible. It can't just be drawn for just straight income purposes.
Right.
But oftentimes, if you're accessing this, again, it comes down initially to a need for estate tax planning, right? But oftentimes, if they need to access that, there is something within that: health, education, maintenance, and support, in one of those categories that is kind of maybe really pushing them toward accessing that cash value.
Excellent. And one of my questions was, how can we recognize this opportunity, or any suggestions to help identify this? And you certainly just answered that. First, estate tax planning, right? And then the other is the HIMSS, the health, education, maintenance, and support. I always joke, we in this industry, I swear sometimes we get paid by the acronym. So thank you for spelling that out. But any closing thoughts or comments before we open it up for questions?
Yeah, the reason I believe that this concept is becoming in vogue right now is the sunsetting of the Tax Cuts and Jobs Act, which is coming in 2026. Right now the exemption is as large as it's ever been, over $24 million of exemption. And most people believe they don't have an estate tax issue. And currently, right now and today, they don't. However, if it does sunset in 2026, like it's expected to, that gets cut in half. And that brings a lot more people into an estate tax exposure scenario. And so rather than waiting until that happens and then planning and potentially losing out on the ability to gift more money to the trust, they're looking at options like this, where we can do some planning now. And if the estate tax changes, or if there's any revised legislature that maybe continues on with where things are at now, this gives them some flexibility and access to maybe change their plan, or even potentially withdraw from the plan. Which is why I think, again, it's in vogue right now, because we have about 3 years left to really decide what we want to do before maybe being exposed to estate tax issues, even though today we're not.
Right. Time for the conversation is now. I agree.
Correct.
With you. Yeah. Well, thank you very much for that, Jason. I think it's a good time to open it up for questions. And while we're waiting to see if there are any final questions, I'd like to remind you that today's brew and our full library are recorded and shared on the Brew blog on our website at www.e4.insurance. And we'll do our giveaway now too. Jason, if you would do the honors of picking a number between 1 and 18.
Ooh, 1 and 18.
The pressure.
I will go with lucky number 11.
Ooh, lucky number 11. That's Daniel, please. Congratulations, Daniel. Be on the lookout for a complimentary CE voucher and Starbucks gift card that will be coming your way from all of us here at E4 Insurance Services. Congratulations. And I do see that we have a question in the chat box here. Please feel to unmute yourselves or send more, but I will read the question. Why wouldn't everyone put a SLAT provision in an ILIT as opposed to a traditional ILIT without the provision? Excellent question.
Excellent question. I think in the past, so from my conversations with our advanced markets, the Spousal Lifetime Access Trust is not any type of new concept. It's really become back in favor because of the nature of the products that exist. If you think back 10 years ago, very few survivorship products or estate tax planning products had cash value buildup. It was really all about supplying a guaranteed death benefit, and there was really no need include these provisions. With the way products are designed today, whether it's a variable survivorship product with lifetime guarantees or even an index product that has lifetime guarantees, that cash value becomes much more apparent. And this provision is now becoming more popular and typically added. In any event, it also does depend on how you're setting up the trust and who the trustee is. If there is a lifetime funding pattern, sometimes the SLAT is not the most, I guess, favorable language to use, simply because once the grantor is deceased, it's very difficult to get money into the trust to pay for the life insurance. So you do have to kind of weigh those options. Typically, when we see it on a survivorship, it is more of a short pay scenario to ensure that the funding can take place.
Excellent. We do have another question here. Are there additional crummy notices or anything else that needs to be done when accessing the money within the trust?
No, there's not. The crummy notices are still based on the number of beneficiaries that are listed on the trust. If there is an access to it, it does need to be, the beneficiaries do need to be notified, but in most situations, the primary beneficiary is the spouse, and then the secondary beneficiaries who are not, who do not need to be notified, are the children. So if the primary beneficiary were to pass away, then the secondary beneficiaries become the primary, and at that point they would need to be obviously notified or actually request any type of distribution.
Understood. Thank you. I'm just going to give it another second for any other questions. And I am not seeing any. Jason, thank you so much for coming on today. That was a great topic, great explanation. We really appreciate having you on today, and very pertinent as well.
Well, thank you for having me. And hopefully, with this information, there's some additional things to talk to clients about, especially those that that have been on the fence about estate planning. I think the timing is perfect, and go get them.
Couldn't agree with you more. Thank you again. Tune in next Wednesday as E4 Insurance Services' very own Shane Van Patten, Regional Vice President, kicks off Long-Term Care Awareness Month in November. Shane has over 17 years of experience helping financial professionals proactively integrate insurance into their practices, and wants to help you start your month off with all the tools you need to be able to do the same. Join us as Shane discusses how to have a more comfortable and engaged long-term care planning conversation with your clients. So we're looking forward to that. Thank you again, Jason. Congratulations, Daniel. Thank you all for joining, and we'll see you again next week on The Brew. Have a great week, everyone.